Hi, Mr. and Mrs. Kessler. Welcome and welcome back from your trip. How was your time in South Carolina? Good, good. I'm glad. I'm hoping that you had some time to relax and enjoy some nice weather. Great, fantastic. And how's the family? The kids, Robert and Eileen, are both doing well. Excellent, excellent, awesome. Well, first of all, I want to congratulate you both on your retirement. I know that a transition from any career, whether it be owning a manufacturing business or having teach for a couple of decades, it can be a little bit of a scary transition, and there's a lot of unknowns. Um, Hopefully, after our meeting today, we can put a lot of those worries and concerns to rest and help you feel a little bit more comfortable in your plan moving forward. So that said, I know that each of you had expressed a need and desire to put together a more comprehensive financial plan for yourselves to map out your future in retirement a little bit better. That said, I appreciate you sharing all the data that you had shared with me and as well as your goals. What I would like to do in this meeting is to cover several topics. Um, those would include goals, risk tolerance, your financial health, risk management, investment planning, retirement planning, tax planning, which I know is a big one for you, and estate planning. At the end of the meeting, we'll also go into the action plan, which is included in the financial plan, to give you some specific direction on action that you can take to implement the recommendations that we have for you today. To begin, I know that some of the most important goals for you included reducing any estate and gift tax liability and to ensure that all estate planning documents are in order. So we'll be sure to cover that. I know that we also wanted to review the insurance contracts and discuss the implications of purchasing a long-term care policy. Additionally, you had mentioned that you were interested in reducing your personal income taxes if possible. And lastly, based on your risk tolerance level, we would like to put a recommendation of a diversified portfolio that meets your investment needs and expectations moving forward. So beginning with the second page on your first topic of your financial health, we have a few documents included in the plan here, which include your statement of financial position, ratio analysis, and statement of cash flow. Uh, we can walk through these individual calculations and things if need be to help you understand a little bit better. But what we have found is that you have accumulated a net worth of around 13.7 million at this point, which is giving you a pretty comfortable nest egg to be able to fund your retirement goals and needs. We've also found that particularly with the sale of John's business, with the 20% down payment and then with the monthly installment payments, you're looking at net disposable income of just over $1 million this year. This is what is going to be a bit of a challenge this year with you being in the highest tax bracket. I understand that we're expecting a 44% marginal tax rate between federal and state taxes in New Jersey. Uh, and again, this is largely this year is going to be affected by the large $800,000 down payment from the sale of the business. However, with the monthly installment payments, you will still have some pretty considerable income, at least for the next 7 years and beyond. So, in our first analysis and calculation in looking at this, we have found that you have an exceptionally high current ratio. This ratio is simply taking your current assets and dividing them by your current liabilities. In reviewing your balance sheet, we found that your current assets are $746,000 over your current liabilities of $25,323, and that brings you to a ratio of 29.46. To give you an idea, the benchmark is a current ratio of 1, and a current ratio of 2 is considered a more of a cushioned benchmark. So as you can see at 29.46, it's pretty substantial, but by no means does it indicate an unhealthy financial picture. What it does mean is that there's opportunity for better use of this cash and opportunity growth for those assets. Your current savings and emergency fund is significantly higher than is typically needed. What is typically required for this is 3 to 6 months of expenses. In your case, you would need about just under 280,000 to cover 6 months of your expenses currently, whereas you currently have a emergency fund of 746,000 as mentioned as your current assets. What we would like you to consider and what we would recommend is reallocating about 425,000 of those dollars into a higher yielding investment. We like to essentially take this from the emergency fund and move it into your investment portfolio so that you might grow these assets a little bit quicker, especially because you won't really have a foreseeable need for this high level of cash. So it would make sense to put that money to work for you. Uh, just by doing this, just by investing that 425,000 from your emergency fund, it would bring your current ratio down from 29.46 to 12.68, which is still pretty significant. However, I know that you're looking to buy a new car soon, Mary, and this amount would allow cushion for that, your expenses, and then also for any unforeseeable emergencies. Now, of course, if an unforeseeable emergency does arise and we need to dip into this fund, we can and will need to reassess the situation as it can have an impact on your plan. But nothing to worry about. There's something that we can certainly make adjustments for as needed. Something else to consider is that your liabilities are pretty temporary as they stand right now. Uh, your primary home is already paid off, which is fantastic. Your credit card, I understand, Mary, you're planning on paying that off upon the statement coming due. So that should be taken care of in the near future here. And lastly, your main liability at this moment is that you have a little over 3 years left on the mortgage for the vacation home, which is coming out to be around $60,000 left to pay off. Um, what I would recommend is potentially taking some of that $425,000 excess cash from the emergency fund, and perhaps instead of investing all of it, you can use a 60,000 from that to pay off the vacation home mortgage tomorrow, for example, or this week, this month, uh, which would actually save you just under $5,000 in interest payments over the course of the remaining loan, and would also have an immediate decrease in your monthly expenses of just under $1,700. This would give you a little bit more wiggle room in that emergency fund by taking a little bit of the pressure off of your expenses, and we would still be able to comfortably invest around $365,000 comfortably from that emergency fund without changing too much from that original recommendation. Um, Moving on here, the remaining emergency fund, we would also, instead of keeping in a savings account, checking account, or having it kind of locked up in a CD, we would actually recommend that you remove whatever cash you have set aside for that, or at least a majority of it, into a money market mutual fund that should yield a competitive interest rate to combat inflation, just so that that money, even though it's set aside for emergencies, is still working for you and not being eroded by inflation. On the next page here, you'll see that we had done an analysis of your risk management. Um, in looking at this, we prepared an analysis to identify any weaknesses in your insurance coverage regarding your disability, auto, health insurance policy, your home policies. Also took a look at your life insurance needs and conducted an analysis for each of you regarding that. All the documents, again, are attached to the plan, and we can go through them a little bit more thoroughly and take a look at the calculations and everything as needed if you'd like to. Starting with the home policies, your primary home requires a 80% coverage of $775,000. $775,000 is found by taking your $900,000 fair value of the primary home and subtracting the fair market value of the land, which is $125,000. So the 80% of the $775,000 means that you should have a policy covering about $620,000. Your current policy covers $400,000, so you would have a shortfall of about $36,000 on any given $100,000 loss. So there's a pretty big cap in coverage there that we would want to address. Your vacation home would also need about 80% coverage of the building itself, which is $550,000. Again, the $750,000 fair market value of the property minus the fair market value of the land portion brings you to that $550,000 figure. 80% of that indicates that you would need $440,000 worth of coverage on that policy. Your current policy has $460,000 in coverage. So at this time, that's adequate coverage. It's a little bit more than you need according to that calculation, but it's not excessive, and there's no need for a change at this time. However, we can certainly keep an eye on that if the value of the property were to increase, and we would then need to take a look at increasing coverage there as well. In analyzing your auto policy, it looks like you have pretty adequate coverage there. You're covered up to the full amount of a loss that's needed, minus your $2,000 deductible, so no need for a change there. However, we did notice that you have a gap in your overall liability coverage. Your auto policy and your home policy both come with liability coverage. However, the amounts are not adequate to protect the assets that you had built up over the years. That said, we would recommend that you proceed with obtaining a $10 million umbrella policy for extra liability coverage in case of a lawsuit or any other type of liability that would require that. In reviewing your health insurance, it appears to be pretty adequate coverage. However, it looks like we might be missing some details there. I'd like to at least take a look at what the deductibles look like on that to make sure that we're prepared for any potential high medical payments. Beyond that, as I mentioned, we did a life insurance analysis. The situation with life insurance at your stage in your life, typically life insurance is utilized to cover the income and expenses that you rely on your partner or your spouse to cover with you and throughout your life. But given that you're both retired and you're not necessarily worried about the income that you were receiving from your jobs previously, and that you have plenty of assets to cover your expenses going forward, the amount of life insurance you have is plenty to cover what income you are currently yielding from the Social Security and pension, etc. So there's really no need for any change in coverage there, and there should be plenty to get you through any instances of one of you passing before the other. Lastly, I know that you expressed some interest in a long-term care policy and some of the implications that might surround that. The coverage for long-term care, as you may know, is intended to help with a decline in cognitive or physical health that would require you to receive assistance in completing what they call activities of daily living. These things include feeding yourself, dressing yourself, toiletries, and things of that nature. But we found a policy for you that would pay benefits for up to 3 years or $360,000, whichever comes first, and would have an annual premium of $6,400 for John and $5,180 for Mary. Now, your adjusted gross income limitations would need to be examined in a little bit more detail to confirm. However, medical deductions for 2025 would potentially lower your premiums to $380 for John and $370 for Mary, respectively, if itemizing in 2025. So if achievable, it wouldn't be much of an addition of an expense to give you some pretty significant coverage should the need arise. Moving on to the next section here for investment planning. The documents, again, that we included in this were an analysis of the investment portfolio. We will take a look at your diversification and your overall strategy. Right now, you currently have about 3.8 million in non-qualified assets. These are your taxable accounts that you funded with after-tax dollars, and you have about 1.6 million in qualified assets, which refers to your pre-tax funded accounts, which would be your retirement accounts, your 401k for Johnny or 403b for Mary. Currently, we notice that the non-qualified accounts are lacking some diversification, which is causing some unnecessary undertaking of performance risk. So we'll want to assess that. What we notice immediately here in the stock portfolio is that there are some opportunities for tax loss harvesting and also some opportunities for reallocating the investments to provide a more balanced and higher growth moving forward. Specifically, we would recommend that you sell all of stock A. This is because there's a $218,000 unrealized loss there, which, if realized, would provide you with a little bit of a tax relief against gains of other assets, which in this case we would actually want to also trim the other three stocks to about 15% or less of the total allocation of the stock portfolio. This is to keep allocation of each of those positions a little bit lower. With too high of an allocation in one particular stock, you face a lot of risk, and a lot of things can happen to any particular company that would drive down the total value of your portfolio if one of these companies received some bad news. As we saw with stock A, you took a pretty significant loss on the overall stock portfolio, whereas now your entire stock portfolio is down about $20,000 as a result of one stock underperforming. So by assigning allocations of 15% or less to each name, we would want to add some additional names to the portfolio to diversify a little bit more. We'd recommend having at least 10 other positions, specifically if we are staying with individual stocks. However, we would recommend either using individual stocks or ETFs as long as they are focused on growth, so that we can diversify a little away from the dividend income that you might currently be subjected to. Additionally, we would recommend that you allocate 20% of your total investment portfolio to tax-free municipal bonds if they do indeed create higher yields than the current bonds in your portfolio. This again would help relieve some of the burden on taxes, as in the name they are tax-free, and it would also give you a little bit of protection against any market downturns in the event that we need to get at some of that money for any unforeseeable needs. Carrying on with the analysis, we noticed that your international exposure in the mutual fund portfolio is 38%, and while this is relatively high for an international allocation on one portfolio, it really only equates to about 14% of your total portfolio. So at this time, I think that's still acceptable and no need for a change there. However, we should be careful to avoid purchasing too much international exposure in some of your other investment assets. We want to keep that international exposure below 30% for the total portfolio. If we do find ourselves in a situation where it makes sense to allocate into international exposure in some of those other accounts, we would recommend that you sell some of the international mutual fund and reallocate that to the growth mutual fund that would align a little bit better with your overall goals and risk allocation. In analyzing the qualified accounts, starting with John's 401k, it looks like he is 100% invested in the large cap blend fund. no need for a change here, and this is perfectly on target with your risk allocation and your goals. So we can go ahead and leave that one alone. Looking at Mary's 403B, however, looks like that she has a 100% allocation into a 2025 fund. This is another name for a 2025 target date fund. Um, Typically, with these target date funds, there's not a whole lot of consistency between one to another, but they do tend to reallocate over time throughout your career. Typically, they'll start out a little bit more aggressive in the earlier years, and then as you approach retirement or that target date of 2025, they tend to become a little bit more, or oftentimes significantly more conservative, and as a result, your growth can be a little bit more stifled, and not earning quite as much capital as we would like. So that said, we would like to see the 2025 fund reallocated to something closer to what John has in his 401k, something along the lines of either a blended growth fund or a large cap fund, perhaps an index that tracks the S&P 500. Any of those would be a little bit more suitable for your needs, your risk allocation, and again, to fund your goals. Moving on from that, I know that John, you expressed interest in having us invest the 20% or $800,000 down payment from the sale of the business, as well as the monthly installment payments. What we would recommend is using the down payment to fund the bond allocation of the portfolio. The numbers actually crunch out to be almost perfect for the 80-20 allocation. And so that $800,000, at least a majority of it, can be used to purchase those non-taxable municipal bonds and fill that allocation for you sooner than later, without having to sell other positions at a gain to realize more taxes. As far as investing the monthly installment payments, this is actually a pretty unique circumstance for you that gives us an ability and an opportunity to do what we call dollar cost averaging. This is essentially feathering the money into the market over time, or in this case, monthly, for the next 7 years in your case. That would actually help us to fight against some of that unsystematic risk that the market offers. And in other words, if the market's trending up in 1 month and down another, or up 1 year and down another, by feathering the money in over time on a monthly basis, it'll average out to where we aren't taking too big of a hit and not investing high and watching those assets sink too quickly. Moving on to the next section, I want to go look at your retirement planning. Again, the retirement plan analysis was conducted for each of you and included in the comprehensive plan here. Your current financial position is meeting your retirement goals with both the qualified and non-qualified assets. As discussed before, you guys have accumulated enough wealth to where we're not really too worried about having to fund your goals, and for that reason, we are a little bit more focused on taking on a little bit more risk to grow these assets for your estate and for your beneficiaries. The qualified accounts do grow tax-free, and by that, again, I'm referring to your retirement accounts, the 401k and the 403b. And while these grow tax-free, they would continue to grow. The assets in these accounts would also grow tax-free if rolled over to traditional IRAs, which we will ultimately recommend. However, the distribution, whether it be from the 401k, the 403b, or from those rollover IRAs, those distributions are taxed as income. And you will be subject to required minimum distributions, or RMDs, in the year in which you turn 73. So there's really no immediate way to avoid having to take those distributions. And in other words, you'll be subject to take those distributions on a yearly basis once each reaching age 73. thus generating more income tax on those distributions. Um, to further clarify, the RMD calculations are based on age, life expectancy according to the IRS tables, and the account value of the previous year end. In this calculation, we took a look at applying this to your current account balances. So just to give you an idea of the additional income that you'll be subject to, if you were both subject to RMDs this year, based on your current account values, John's RMD would be about 40,000, and Mary's RMD would be about 20,000. Now again, that's based on this year. We are obviously hopeful and expect to grow your assets in the next few years. By the time John reaches his RMD age in 2 years and Mary reaches her RMD age in 5 years. So we're likely to be looking at a little bit higher numbers than those, but want to give you a rough idea of what we're looking at. I know that you had also inquired about Roth IRAs. Roth IRAs are particularly effective and come with a high tax advantage because they not only grow tax-free, but those distributions that we just talked about a moment ago are also tax-free distributions. And on top of that, there is no required minimum distributions for Roth IRAs. And conversions from your traditional IRAs to Roth IRAs are possible and effective for a lot of folks, but in your case, they're unlikely to be effective due to you being in the highest income tax bracket, again at that 44% marginal tax and federal rate. So that's not something that would be too effective in your case, unfortunately. However, if your income is lowered in the next few years, then we can take a look at possibly converting those assets later on. As far as contributing to the IRAs or making contributions at this time, John had earned income of $12,000 in 2025, whereas Mary did not have any earned income. You're not able to contribute more than what you have for earned income in a particular year. So John would be able to contribute a maximum of $8,000, which includes the catch-up, the $7,000 maximum, including a $1,000 contribution catch-up for folks over the age of 50. And then he would be able to contribute an additional $4,000 to Mary's IRA to equal that total $12,000 of earned income. You unfortunately will not qualify for deductible contributions or Roth contributions due to your high income level being over $246,000 for a married couple filing jointly. Moving on to the income tax planning, the tax calculations again were presented for the down payment, the installment payments, and also for the 1918 inverted Jenny stamp that you inherited from your father, John. Taking a look at that and starting with the investment interest here. Let's see here. Excuse me. So starting with our first recommendation, as discussed, we'd recommend that you purchase some of the municipal tax-free bonds for your portfolio to help relieve some of that tax burden on your income and growth. Additionally, as discussed, we would recommend that you reallocate the portfolio, your stock portfolio, into growth stocks and ETFs to avoid additional dividend income. On the second recommendation here, taking a look at the 20% down payment for the sale of John's business, this will not be taxed as ordinary income. Instead, it'll actually be taxed as a long-term gain since you technically held the asset for more than a year. This rate would be 20% instead of your marginal 44% rate. And the calculations essentially come out that your tax liability on the $800,000 payment would be $124,000 that you would owe in taxes. This is because you would actually get to deduct $180,000 cost basis, leaving with a $620,000 taxable gain. And again, the result of that is $124,000 in taxes owed. The installment payments will receive a similar treatment. We calculated the first installment payment to be $47,262. Of this amount, $17,333 will be interest and taxes ordinary income. $6,734 will be classified as return of basis and won't be taxable. And then finally, the $23,195 that are left will be taxed at a 20% rate as a long-term capital gain. In considering the tax liability for the potential sale of the 1918 inverted Jenny stamp, we calculated that you will likely be subject to a 31.8% tax rate on that profit of that sale. The collectibles are taxed at a different rate than, say, the sale of your business or than income. The collectibles are typically taxed at a rate of your ordinary income, but up to a maximum of 28%. Since your ordinary income exceeds that rate, you'll be capped at 28%. However, there is a special additional tax rate referred to as a net investment income tax of 3.8%. Again, this is additional to the 28%, and it is based on exceeding a certain modified adjusted gross income level, which it appears that you will exceed in the year that you are considering selling the stamp. You will, however, be able to deduct the cost basis of the stamp, which for you is $600,000, and you would also be able to deduct any commission paid to a third party for anyone that helps you in the sale of the stamp. In our conservative analysis of this sale, again, you would be taxed 31.8% on a roughly $1.6 million gain, assuming that $2.6 million fair market value in the year that you decide to sell the stamp, and this also assumes a 15% sales commission. Finally, we evaluated your itemized deductions for 2025. In consideration of the real estate taxes paid on your primary and vacation home, interest on the vacation home mortgage, and state income taxes and charitable donations, we arrived at a potential itemized deductions of $25,500, which also included the limitations around the SALT tax. However, the standard deduction for married couples filing jointly is $30,000, and because you're each over the age of 65, you would actually receive an additional $1,600 deduction each, bringing your total standard deduction to $33,200. To increase your itemized deductions beyond this amount, we would suggest additional charitable donations. We recommend doing this specifically through qualified charitable distributions, or QCDs, from John's IRA, since he is qualified as someone over the age of 70 and a half at this time. The IRS allows for 100% deduction on these QCDs, so you would not owe any income taxes on the distributions, and they would also take a portion away from those RMDs, which you would have to pay income taxes on otherwise. So that would make the most sense for this situation. Moving on to estate planning, we again include some calculations that are included in the plan here, but in your current situation, neither of your estates are subject to taxes, given that neither of you have an estate over the size of the estate deduction, which is just under 14 million, the exclusion rather. However, there was an issue here in the analysis that indicated that you'd be subject to excessive probate fees and expenses at this time. There's no essential estate planning documents in place, such as power of attorney or healthcare proxies, to manage your affairs if either of you were to become incapacitated. You did have the wills taken care of, which is a great start, but we'll definitely want to address those other areas. Mary's life insurance policy is payable to her estate, which also further increases her probate taxes. John's 401k currently lists the Salvation Army as the sole primary beneficiary instead of Mary, which we'll want to make an update to as well. What we recommend is that you change the title of your vacation home and also the vehicles from sole ownership to joint ownership, along with any other assets that are listed under sole ownership. This will help avoid probate costs, as these assets will transfer directly to your spouse in the event of your death. We'd also recommend that you visit an estate planning attorney as soon as possible to obtain powers of attorney, healthcare proxies, some of those other things that we discussed. You can also consider putting a trust in place that holds ownership of your assets, which would also help you avoid probate. Alternatively, we can also add transfer on death designations to some of these assets, which will help them pass without probate. A recommendation, excuse me, and again, we would recommend that John update the beneficiary of his 401k from the Salvation Army to Mary. So that's something that's pretty simple you can take care of relatively quickly here. Last point I'll make there is that you should make an appointment as soon as possible with an estate planning attorney. This is going to be needed to accomplish estate planning objectives that should be made as soon as possible, as mentioned above. The cost for implementing these recommendations should be around $10,000 after including the change of property titles and the attorney fees. This is something that you can pay for, again, out of that cushion that you guys have built in the emergency fund and your joint checking account. So no issue there. Lastly, I know that we covered a lot here, but to sum up the action plan and steps that you can take in the immediate near future here in implementing some of these recommendations. One, we recommend visiting the estate planning attorney so as soon as possible so that you can change the titling on the vacation home, as well as the beneficiaries of John's 401k and the beneficiaries of Mary's estate. And moving on from there, our next recommendation would be to contact your insurance agent to increase the coverage on your primary residence. As we discussed, it has lacking about $220,000 in coverage at this time, so we'll want to get that taken care of as soon as possible. What you can also discuss with your agent is increasing your deductible from $500 to $2,000 to help offset that increase in premium from the increased coverage. Additionally, we recommend that you inquire about the $10 million umbrella policy for extra liability coverage when you speak with your insurance agent. That's something that should be relatively cost effective and will certainly provide necessary protection. And lastly, let's work on finalizing the long-term care policy I recommended. That's something that I'll follow up with you on the next steps for this next coming week. Lastly, our third and final recommendation concerning your investments. Let's move forward with liquidating a portion of your stock portfolio to execute the tax loss harvesting and diversification into more growth-oriented names. I'll help you with the rollover of the two retirement accounts into rollover IRAs and the reallocation of Mary's qualified assets into a growth fund and away from that 2025 target date fund. At our next meeting, we'll discuss the investment of the 20% down payment and the excess emergency fund cash to bring your bond allocation up to 20%, and so that we can ensure we are implementing a tax efficient investment strategy focused on growth, accordance with your risk tolerance, and I'll also present our investment strategy for the monthly installment payments at that time. So I know we covered a lot. I know it can be a little bit overwhelming, but we do have all this that we discussed that is written in the plan here. So if you have any additional questions, you can reach out to me. However, the recommendations made in this plan, we do deem to be necessary ones, and you can always review the details of the plan, the calculations on how we arrived at the recommendations. And again, feel free to give me a call with any questions in the meantime. Again, I thank you both for your time. I know this can be a little bit daunting, and I appreciate you setting aside the time to come in and meet with me. And I hope you enjoy the rest of your day and are at least a little bit more excited for retirement now and can put some of these concerns at ease. So thank you both, and I'll be in touch soon.